Welcome back. Well, let's focus on the stock of the last couple of sessions. Today as well, Sula's high, even yesterday's trading session did quite well. Remember, they came out with an operational update and the street likes it quite a bit. We are currently joined by Mr. Rajiv Samant, the MD and the Chief Executive Officer of the company. Hi, good morning. Thanks so much for joining in. Well, let's focus on a couple of points.
Hi, morning.
We have your quarter 3 numbers and they're looking quite good and the street is clearly excited. Safe to assume now that we'll end this year with a growth of closer around 30% on the top line. And if you could break that up for us, how much of it is volume-led, how much of it is price-led?
So growth in Q3 and in our 9 months to date has been very strong. The entire year is looking like it's going to be a strong, solid year. And, this is what we've been talking about, that wine is a growth story. Wine is here. We are not here to compete with whiskey. A lot of people say, but India is a whiskey drinking country. And that is not what we are talking about. We are not looking to, touch the levels of whiskey anytime soon. But in terms of growth, we are seeing growth much higher than spirits and beer. That's what the story that we are talking about. And we see that continuing, and we see Sula continuing to lead that. So Q3 was strong. It was our highest quarterly revenues ever. So we have now left the pandemic nicely behind, and we are trading these days the kinds of revenues that we are seeing are higher than pre-pandemic.
All right, Rajiv, so you're clearly sounding quite optimistic on business. Consumption story, at least in the business that you're dealing in, seems to be pretty good. But Rajiv, give us a number. What's the growth outlook from here on and the rough margin band we should be looking at?
So I'm sure you're aware that I can't give you a projection for the year end, but I would say that the Q3 results are pretty much in line with what our expectations are moving forward. And you're not totally out of the ballpark. You have said a 30% growth for the year. I'm not going to commit to that, but definitely very strong growth over FY22. And we don't see any headwinds. So we have a great harvest coming up. It's already begun, looking really strong in terms of quantity and quality. Here in India, we have been really lucky in terms of climate conditions, global warming. This is going to be our fourth record harvest in terms of quantity and quality in a row. So that bodes really well for the year and the 2 years ahead as well.
Rajiv, hi, good morning. Is there scope to improve your gross margins further? I'm asking because, there's a graph on the screen which is indicating that, of course, FY20 was not a comparable year, but from sub 50% gross margins, you've now gone to 70% plus. Is there scope to improve it further? If yes, how?
So I think already we've seen significant growth, as you've pointed out, 70% gross margin. At this point, I must say that it's not necessarily a priority, the top priority for the company to improve it further, because at 70% gross margin, we're throwing out cash. We're in a very comfortable position. We now want to plow that cash back into growing the business, into penetrating wine into tier 2 cities. Until now, wine has been very much a metro game, a few tier 1 cities. We want to take this magical liquid, what we call it, out to tier 2 India, and we want to spend money in penetrating that market for growth to come 2 or 3 years down the road. I think I'm very comfortable with a 70% gross margin at this point.
Rajiv, hi, good morning. And that makes sense, right? So you want to go down the price curve, not high. I'm assuming from here, if you want a greater acceptance, greater penetration, etc. On the season, the harvest season, that runs for you from December to March, right?
Yeah, that's right. Significantly January to March.
January to March. And that's looking solid. I mean, no problems at all.
Looking very solid. No problem at all. It's an agricultural crop at the end of the day. So we always factor in that, there's a 2%, 5% wobble here and there. But looking at it from a historic point of view, a very solid harvest.
What about the other? I think you were asked this during the time of the IPO as well. Imported wines, right, which make up I think 20% of the total wine sold here. But these FTAs, for example, with Australia, agreement to lower these import duties over a period of a number of years, of course, not happening immediately. Do you see? Do you sort of assess that as significant competition down the line?
So the Australia FTA has already been signed, and we are very comfortable with the outcome of that. We do believe the Indian government is definitely looking out for farmers, for Indian farmers, and is not going to sell Indian farmers down the road. So while there have been concessions, those concessions have mostly come at the higher end of the price spectrum. And, you can say that 95% of the Indian wine business is not impacted by those price reductions. What's going to happen is that some of the most expensive and iconic Australian wines are going to become significantly cheaper. But, from the consumer's point of view, what it's going to mean is a 5,000 rupee wine on the retail shelf might become a 4,000 rupee wine. But you should know that 95% of the Indian wine business at this point occurs below a price point of 2,500 rupees. And Sula, of course, is by far and ahead the market leader in those price points.
Always great to hear if wine gets cheaper, right? It's great for the consumer. But Rajiv, you've said in the past that you're looking to sort of move up in that value chain. You're looking for 2,000 rupees plus category as well. How many launches are you planning in that segment? And what would that take your sort of revenue contribution to in the premium category?
So, in the last couple of years, our premium category, I would say 700 rupees and above, and especially 1,000 rupees and above, has grown much faster than the more popular wines. Having said that, Q3 saw strong growth across categories. I should point out that our cheapest wine in Mumbai is as low as 260 rupees. Our most expensive own brand wine is just a shade under 2,000 rupees. We saw strong growth across that. But from a management point of view, we are very focused on wines above 700 rupees and especially above 1,000 rupees. We are by far and ahead the market leaders there. As you go up the price ladder, Sula's market share starts to go up and up. There's a lot of competition, of course, at 260, 300, up to 500 rupees, a lot of competition, fair amount of discounting, decent margins, but nothing like the margins that we get from 1,000 rupee plus point. So that is very exciting. We've already had a very cool launch about 6 months ago. Our Moscato, India's first Moscato, already sold out the first vintage. This is a wine we have great hopes for across the country. At this point, I can't really speak about upcoming wine launches.
I think the pandemic changed wine drinking habits as well. I mean, actually, at least around me, I've noticed a pandemic of wine drinking, which has been incredible. Rajiv,
the whole home delivery thing has also made it so much easier. There's a lot of people, and especially a lot of our consumers are women. Yeah. So this is not your dad's generation liquid where, the elder guys would be on one corner of the room all drinking their whiskey. Wine is for the new generation. It's something that's enjoyed by women and men. And you are going to see it more and more as the taboos among women drinking start to go away, which is happening more and more in India. You're going to see more and more wine.
Got that. I have one question, and that's, been on my mind for a while. At the time of the IPO, if you had analyzed the preceding 5 to 6 years, there was absolutely no growth in Sula's earnings. It's just in the last, say, about 1 to 2 years that you've started to show some serious growth. Why is that?
So, you have to slice and dice the way those numbers played out. We had a big emphasis on our imported brands. That was a much larger part of our portfolio. So our traded goods was something like 30% of our turnover a couple years ago. And really, that portfolio was making hardly any money. We had taken a stake in a distribution business in Mumbai. That turned out to be not a great decision. So coming through the pandemic and coming out of it, we are focusing on our own brands and our wine tourism. These are our biggest pillars, and we are doing that with a huge focus on sustainability. So, our cost structure has been getting better and better, and we've realized that that's where the money is, in creating your own brands. Sula knows how to do that. We have mastered that. We've shown we are successful again and again. Sula Vineyards is today the most loved homegrown consumer brand, one of the most loved, and especially in Alcobev. We've done that. So we're going to concentrate on that, and I think you're going to see maybe even better times ahead.
All right, Rajiv, pleasure speaking with you. Thank you very much. Appreciate you joining in here on CNBC-TV18. Thanks indeed.
Thanks so much.
Sula stock's doing very well. Yesterday, Quant Mutual Fund bought 10 lakh shares. The stock was limit up in a trade yesterday. It's doing well today as well. On to our special segment, Quarter Se Quarter Tak. Nigel is standing by on the big wall to take us through expectations from the cement sector this quarter. Nigel, over to you.
Well, thanks a lot for that. For the cement space, brokerages are expecting a recovery in Q3 in comparison to a weak showing in Q2, before full-blown likely recovery in the fourth quarter. Credit Suisse on the Indian cement sector, they say that they expect strong profitability recovery from the second quarter bottom. The key factors that are at play include realization improvement post the monsoons, the stable pet coke prices, higher volumes, as well as lower maintenance cost. They have quantified EBITDA per ton to improve by around 175 rupees to around 200 rupees per ton, which is mostly going to be led by a 100 rupee improvement in realizations. Jefferies, well, they expect volume growth in the range of around 11% on a year-on-year basis for the cement space. They're also in the camp who believes that there will be a 175 rupee quarter-on-quarter improvement in EBITDA per ton, but they also highlight that EBITDA per ton will be down by around 135 rupees on a Y-on-Y basis. They also highlight that the aggregate EBITDA will increase by around 40% quarter-on-quarter, but will yet decline by close to around 6% on a year-on-year basis. But from here on, the EBITDA per ton is likely to look up as pet coke as well as coal prices, they are down between 10 to around 20% if you compare it with the average that we saw in 2022. Jefferies also highlights the likely outperformers and underperformers for the quarter gone by, that's quarter three. They expect Dalmia to report the strongest year-on-year growth in EBITDA, driven by strong east pricing and healthy volume growth. That's going to be boosted by the new capacity that's come on stream, which will stabilize. While the sharpest year-on-year decline is likely in ACC, Birla Corp, Shree Cement, as well as JK Cement. Now, running through the expectations on individual stocks, Jefferies expects Ultratech to deliver revenue growth of close to around 20%, which will be led by 13% volume growth, and EBITDA will improve by around 120 basis points on a sequential basis, but will decrease by a similar amount on a year-on-year basis. Shree Cement, well, the top-line growth of around 22% will entirely be led by higher volumes, and though there'll be a mild 150 rupee improvement in EBITDA per ton, it will be lower by close to 400 rupees on a year-on-year basis. Ambuja Cements will lag on the top-line growth, which will be just around 7%, but will bounce close to 250 rupees per ton on a low base. Dalmia Bharat and Nuvoco, well, they'll put in a solid showing with improvement in EBITDA per ton on a year-on-year basis, as well as on a quarter-on-quarter basis. That's because of the solid pricing we were talking about in East India. Finally, to wind this down, let's run you through a quick snapshot on the valuation front. As we can see, well, if you can pull up Dalmia as well as Nuvoco, they trade at a bit of a discount in comparison to its larger peers. Well, to understand about what are the expectations, Naveen Sahadev, the Director Nuvuma Institutional, joins us on the show. Hi, Naveen. Morning. Thanks so much for joining in. What are the numbers you're working with? How much is the cost likely to cool off on a per ton basis in quarter three in comparison to quarter two? And also, what is the cooling off you're working with for quarter four? Go ahead.
Right. So Q3, I think most of the companies have already, made it clear that they are not really looking at any kind of a major decline on the variable cost front. Because if at all there is a marginal decline on the fuel front, it will get offset by a slight increase in the freight cost, because your railways is now after a gap of 2 years, your railways busy season surcharge gets added from 1st of October. So from a variable cost perspective, there's not going to be any relief or a marginal relief at best. Q4, yes, because the bulk of the impact of this recent decline, as we say, in pet coke prices or even imported coal for that matter, that will accrue in Q4 largely. So maybe around 150 to 200 per ton kind of a decline definitely is what we can expect in Q4. But sorry, nothing in Q3 is what we are expecting.
Okay, so a decline in the cost per ton only Q4 onwards. Got that. Naveen, good morning. Between the large and mid-cap cement companies, what do you like now? And is this a good time to buy?
See, usually it's a commodity, right? So cost is definitely has its own volatility. But as long as the industry has pricing power, I think we should be comfortable. But what I see is precisely this factor being missing. You just look at it past few quarters, even when the cost was absolutely going crazy, even then the industry could not display any pricing power. You look at December volumes, they are for the industry up in over 10% or even 12% for that matter. Most of the company volumes even for the full quarter, are in upwards of 10%. Despite that, we are in middle of January. There is absolutely no price increase. In fact, pockets of North and South India have seen prices decline in January. So I'm not really excited about the cement space in totality. But couple of stocks, yes, we could look at. So we're looking at Ambuja Cement in the large cap space and JK Cement in the mid cap space.
Okay, all right, Naveen, the factor that y'all have highlighted as well is what the new promoter of ACC and Ambuja do with regard to their plans on expansion. My question to you is, what if they go the organic route? Everyone's talking about inorganic growth. What if they say, we are going to be looking at expanding organically? Will you view that negatively for the sector?
Frankly, so far the company has not made any official comment. Okay,
Yes.
they've just given a broad guideline that they will be looking. Doubling of capacity in 5 years and becoming the industry leader or a market leader, and also the most efficient player by 2030. Now, within that context, what we understand is because acquisition or inorganic growth is completely a matter of speculation, and but it's pointless even commenting that, because unless a deal is done, you can't really comment anything. But organic front, yes, because in my personal view, the growth for ACC Ambuja will be a mix of both organic and inorganic. And what we understand from our channel checks is that company is definitely engaging with several equipment manufacturers to consider and pursue organic expansions as well. So that gives me more conviction that the growth plans for ACC Ambuja will be a combination of both organic and inorganic.
All right, but if it's only organic, will it be viewed negatively? Because that would be more supply that's coming on. You're not factoring in much of inorganic growth from that capacity that they're talking about, from 70 almost doubling.
Either ways, I would be cautious because it's not just organic growth. Because if at all, there are bunching up of capacity, then it's negative. But even if, let's say, there is an acquisition, and assuming that these acquisitions, happen of some of the companies which are not or operating at very low utilizations of 20-30%, Ambuja or ACC certainly will want to operate it at a higher level. So even a consolidation scenario to me is a little cautious, at least for a couple of quarters before it gets into that positive mode of consolidation. And organic, as you rightly said, if there is bunching up, then it will be negative. So overall, we have a cautious or a neutral stance on the sector. We're not positive on the sector overall.
Okay, all right. We'll leave it there. Thank you very much for your time, Naveen. Appreciate it. And we'll touch base once numbers start to come through. Look at the market. It's flying away 100 points now, 110 points. It's looking steady, 18,003. The 20-day is about 50 points out. 18,051 or so is where the 20-day is at. HUL, I think, deserves a mention. It's up 2.5%. Stocks at 2662. It's perked up quite nicely. Minda Corp is another one which is looking good. It's up 5%. Very large volumes. And then there is specialty the restaurants, right? 274. And that one is up 10%. So just three names I wanted to quickly mention before we move on. We'll take a break here. Mitesh will be joining in for some technical trading ideas on the other side. Stay tuned. Welcome back. 100 points on the Nifty. Mitesh is with us. Mitesh, would you go on the fact that maybe there is more here? Maybe another test of the 20-day like yesterday, and then what would you do, Mitesh?
Prashant, the initial idea is that once again, in fact, yesterday morning we were quite positive, and then the decline kind of took us by surprise. But I think that entire setup is coming into play right now. So 17,950 being the stop loss, I think the Nifty should now head towards 18,150 and then possibly even 18,250. So maintaining some kind of positive bias on the indices over here. And on the stock side as well, I have a buy on Godrej Consumer. That's a stock which is breaking out on the upside. So buy here with the stop at 920 for targets of 960. And the other stock is Balrampur Chini. That's a stock which after consolidation is trying to break on the upside. So this is a buy with a stop below 392 for targets of 415.
Okay, thanks a lot for that. So Godrej Consumer and Balrampur Chini. In fact, talking about sugar, let's get a quick grip on what's happening in the commodity markets. Manisha, good morning once again. What's the one commodity that you're looking at today?
I'm looking at metals as a sector, and we have seen mixed cues coming in for this one. And today as well, it's choppy because of the Chinese data that has come in, which has put some pressure onto the prices here. But even with this bit of a correction, we still are trading on the higher side of the range for many of these metal prices. Well, the reasons being, of course, you are looking at China taking a lot of steps to boost economy. You also have weak inventories and supply disruptions impacting many of these metals, and that clearly has been supportive. Markets also are looking at recession concerns ease a bit. It's soft landing that everybody is talking about, and that has taken that fear off the markets as well. But what is weighing on right now is the Chinese data. If you look at the retail sales numbers, that came in up by down by 1.8%, lesser than what the street was anticipating and much less than what we saw in the previous year, and that's bothering. Industrial output also has risen 1.3%. Markets were anticipating 0.8, but last year was 2%. So we are looking at weaker numbers in that sense. And GDP clearly stagnating when you look at China at around 2.9%. Is what is weighing onto the markets. But when you look at the individual fundamentals, that is where you will see spot of supporting fundamentals coming in. Copper prices, even with this decline, are trading at near 7-month highs. From 640 to 763 has been a one line of gain coming in for copper MCX prices. So some bit of a correction on your screens right now. But the markets have been supportive because the Chile copper output is seen down by 6% in 2023. We are looking at political unrest in Peru. That will be supportive. And there are reports now suggesting that the global copper inventories are just at about 2 days of global consumption. So every dip is still a buying opportunity, is what experts tell us. Aluminum also is trading at a 7-month highs right now, and we have seen global inventories continue to decline quite sharply. It is now at the lowest since 2002 and at just about 1.4 million tons. Inventories is a concern for zinc as well, where the inventories are now at the lowest in this century now. LME inventories have declined to 36,525, and with the kind of decline that you have seen, nearly 60% of those inventories also are marked for physical loadout, and that would mean once that happens, that you will have LME zinc inventories at a few hours of global consumption. So as and when demand starts to come in, there is expectation that you could be looking at further highs in case of metal prices. The output also has declined by 3.2% in the previous year, and we are looking at some kind of a deficit continuing for 2023 as well. The next chart should show you on what we've done in 2023 until now as far as the metal prices go. It has been a very strong gain. The best of gains clearly coming in for tin with 16% of gains, 10% up for zinc, 13% for aluminum, and copper prices up by nearly 9% for 2023 until time. So very good start to 2023, strong gains continuing here.
All right, thanks a lot for that. Strong gains in the commodity space so far in 2023. But as world business and policy leaders gather in Davos amidst multiple headwinds for the global economy, top Indian CEOs are confident about the India story. Tata Steel's TV Narendran is bullish on India's prospects as an exporter of steel. Listen in to their comments.
China opening has certainly helped commodity prices. So not just steel, if you look at copper prices, it's gone up about $400-500 in the last month. Steel prices have gone up in China. Domestic prices have gone up by about $100. So overall, we see a positive sentiment. Iron ore prices have gone up. Coal prices have gone up. Not all of it is good for the steel industry. But overall, the sentiment is changing in China, certainly. And that has a huge impact in the world. As you know, China is looking good. India is looking great. So I think in many ways, many parts of the world are picking up where it left off over the last few months. So we are quite positive over the next 6 months. And there's no reason why India shouldn't be a big exporter of steel. You know, India has the raw materials. And why should Japan, China, and Korea be exporting steel when they don't have the iron ore and we have the raw material, and we should be exporting steel, creating jobs? The second part is, yes, when I look at our customer segments, if you look at automotive, they are back to where they were 4 years back. If you look at construction, it's quite strong. Industrial buildings, a lot of investments going on in supply chains, warehousing, a lot of investments in oil and gas. So all that will trigger private sector investment. So I think we are probably 6 months to 1 year away from getting private sector investment back.
Okay, so there is private sector investment that's coming back, but perhaps in the next 6 months to a year. Let's slip into a quick break. Up next, Lata will get chatting with Shyam Srinivasan of Federal Bank, one of the big movers. The company reported a very good performance in Q3, multiple brokerage upgrades. You want to stay tuned for this one.
Federal Bank stunned the market with a massive 27% rise in its net interest income, and that was helped by a jump in its net interest margins to 3.49% from 3.3 a quarter ago. Its profits are up 54% year-on-year. Well, it's fired on all cylinders, posted a higher return on assets of 1.3% and is guiding as well for a 1.35% ROA for FY24. Joining me for his 50th results interview with CNBC TV18 is Shyam Srinivasan, Managing Director and CEO of Federal Bank. Good morning, Shyam. Well, golden jubilee and a golden set of numbers. This is terrific. So first, let me allow you to explain what went so right for Federal Bank, both in growth and margins.
Thank you, Lata. Yes, it has been one heck of a ride. We've had many good quarters and some challenging quarters, but this one thankfully turns out to be a good quarter. I think it's been fairly broad-based, right? We've had all-round sort of improvement in every measure, and it's reflecting the work the bank has done across various periods in time, across different product segments. We've long sort of held the view that if you focus on the credit quality being good without undue risk, then the book ends up working in favor of the bank. Our mix has been, as you know, fairly even-paced between corporate and wholesale, and within corporate and within corporate and retail also is secured, unsecured blend is fairly sort of equally played out. So we haven't overly emphasized in any one business. So I think all that has worked in favor. Yes, I mean, certainly this is 5 days of banking summer, as I say it, when the interest rates are where they are, and there is some kind of a timing difference between where the interest rates are passed on the credit and the deposit structure follows. There's some tailwind in favor of the bank. But I think even if you back that out, sort of underlying performance has been very robust across. But most heartening is the ROA expansion has come at a time when the balance sheet has also expanded. So it's not like we've shrunk our way to growth.
I agree.
The book has grown. The book is now, the balance sheet has crossed 2.5 lakh crores, and deposits have crossed 2 lakh crores. The credit book is about 170,000 crores. So it's kind of, I would say, a period when many of our measures are coming together, which gives me the assurance that the periods ahead should only get better. Yes, there may be some external headwinds, but I think we are in a good place to ride it out.
Okay.
So on balance, we are in a good place right now, and I hope that will continue for quarters ahead.
No, I agree with you that there is a huge tailwind even for the sector. I mean, yesterday we had even Bank of Maharashtra numbers, which were, surprised on all parameters. And that has been the case for several banking numbers. And now let me put the buts and the skepticism for you to defend and see how far things can be, how long things can be good. For instance, margins. We are already seeing banks pushing up their deposit rates. And some of them are raising, even the big ones like HDFC Bank and SBI are raising certificates of deposit, CDs at, higher and higher rates. So are you confident that margins can remain higher even in the current quarter? When do they peak off?
I think in the various calls yesterday post the results, we were quite sort of elaborate in our explanation of what we think will happen over Q4 and the early part of next financial year. Certainly, like I said, the 5 days of banking summer, there's some kind of margin expansion that has happened because of timing. So that will get moderated. But you must believe that there is some kind of franchise value banks like us have. Even through this quarter, if you saw the retail deposits is what grew. Our deposits sequentially grew 6%. And a large part, and I repeat, a very large part is customer deposits. Of course, it comes at a price. We are not saying that it doesn't come at a price, but we think the retail part of the bank and the franchise is in a good place to grow. That said, yes, margins may moderate to some extent, but over a period of time, the business mix, the credit quality, all this comes into play. So I don't think it will come crashing down. Yes, maybe
not crashing. Even your CASA, I mean, your current and savings account have risen by 7% year on year. But as a percentage of total deposits, it's come down from 36.4 to 34.2. So what I'm saying is that increasingly people will want to get more bang for their buck from the banks, the depositors, I mean. So will fourth quarter also see an improvement and then you peak off, or may you peak off this quarter itself?
No, I would think fourth quarter is not going to be much higher, but it will not be much lower either. because the full effect of the deposit pricing takes a good 2-3 quarters. And if there is another rate increase, which could or couldn't be, then that will have its own playthrough, right? So I would think the impact of pricing on deposits will start showing on the margins of banks, but depends on each bank's margin profile, how much will be the fall. Yes, some flattering has happened, but that may get tapered off, but I don't know if it will be very substantial for every bank. In our case, we believe maximum about 10 basis points would be the impact in the coming 2 quarters.
Okay, that's good to hear. Now, let me come to advances up 19.5%, almost 20%. Do you see enough demand? You know, in the HDFC conference call, the bankers were saying that they had to refuse some of loans, some 30,000 crore of loans, because, you know, there was too much of pressure of asking for lower yields. Do you think there is so much competition that you can't raise your rates much?
Again, it would vary bank to bank. Our general philosophy is if the credit is good, we should be in that business. Right? I have a 1.2% share of bank. They may have 10, 12, 13%. So the different banks have different parts of their journey. So I would not follow.
No, the reason why I'm asking you is not margins, but the reason why I'm asking you is quantum of loan growth, therefore.
Yeah,
you think
so
it
that's what
continues at 20 thereabouts?
Yeah, in the high teens is very possible for us, given our sort of phase of growth and the opportunity I see. As long as we don't go crazy and do the wrong things, 18% growth is very possible for us.
Okay.
And that's something that I'm confident we will deliver.
Okay, but you may have to raise capital. I think your capital adequacy is something like 13% or thereabouts. If you grow at this pace, 20%, you may have to raise capital in FY24?
I would think sometime in FY24, yes. Remember, this capital adequacy doesn't include the plowback of FY23 profits, which we do only at the end of March. But that said, our capital adequacy will go to about mid-14. But as a prudent practice, we would consider, but I don't know whether it's in Q1, Q2 of financial 24. But I do see an opportunity to come up with growth capital, and for all the right reasons. We may be in the market sometime in FY24.
There's an insatiable hunger for Indian banking stocks, so perhaps even now is as good a time. But Shyam, now let me come to what the Reserve Bank put on its website in terms of a discussion paper. Now it is not just incurred loss that has to be provided, but expected loss. What may be the impact, not just on your bank, but banks in general?
I would think, we have at first glance between the IFRS framework and the more recent discussion paper that came out late last evening, there are some changes. The IFRS, we had a sense of what kind of impact it would be. I thought the capital adequacy impact would be 1.5% for banks. And the provisioning impact would be higher in the near term. But that said, many banks have capitalized well, have increased provision coverage quite substantially. There are some definitional differences in the new circular that has come out. These are draft papers. I would think it will go through a fair amount of change before it goes on stream. But the hardening aspect in that is, I think they're talking of it across a longer period of time, not a knife cut over on one day. So I think they're giving a smooth landing for banks over a period of time. That said, there will be some impact for banks in terms of additional provisioning, only for the fact that the recognition between stage 3, stage 2, stage 1. I think there's some definitional change that is coming up in the discussion paper. But headline, I would say that it's not going to be very disruptive. I do think RBI is taking into view the fact that they don't want to, the banking system is in a good place. They wouldn't want to sort of jerk it away in a hurry. So I would think it would be fairly digestible for most banks. Like I said, in our earlier judgment, the ECL under the IFRS, the impact was about 1% on capital. That may still hold, but this time around it's multi-year. So I think if you raise capital, and I also think we'll start providing more, between now and whenever the timeline comes. So there'll be a little more conservative, prudent provisioning banks will indulge in over the coming quarters.
No, that is exactly the point. Since you will start providing prudentially, that may chip away from the kind of profit expectation and ROA expectation that is built in. You must have calculated the ROA guidance of 1.35 before you saw this paper. Do you think now it may be a bit of an ask because you will want to provide more?
I don't know the impact of it, but I think the big thing is credit provisioning. At least I can say with some confidence, the requirement in the erstwhile IRAC norms is coming down quite meaningfully as the portfolio qualities continues to improve. So there may be some space available for us on that count. But I don't want to be too judgmental. We'll work that through.
Okay. Just this one sentence was puzzling. I mean, it looked like it might mean a lot of provision. Expected credit rules include interest lost over the life cycle of the loan. Now, will that mean, therefore, that provisioning will include?
I think that is for stage 3 assets, is my sense.
Okay, so that won't be a great deal.
Yeah, I don't think it will be. I think it will be for stage 3 assets.
Okay, all right. Finally, Shyam, you think corporate loan has arrived. In your case, corporate loans are as good as retail loans in the sense, in terms of the amount. Do you think that corporates now are hungry enough to take it higher?
I think I said this earlier to you guys on an interview. I believe that last year, the one that we are sort of going through, and the couple of years ahead, banks being the principal source of provider of credit for corporates is now real. And those banks that are positioned and are willing to take that exposure will find enough opportunity. We've seen a meaningful demand, maybe because we are a small share player, therefore we are anxious and keen and willing. We are seeing, we meet 4 or 5 times a month for reviewing corporate credit proposals. Right, so there is enough in the pipeline, and I don't see that drying up very soon.
Okay, that's good to hear for the entire banking sector. Shyam Srinivasan, pleasure speaking with you. Here's wishing you many more glorious years in Federal Bank itself, many more golden years. Thank you for joining us.
Thank you.
Well, wrap up on Bazaar on that optimistic note. Chartbusters up next.